Hey guys, my name is Evan and this is Sense or Sense. And today I want to bring you something that makes me a lot of sense in the long term. I've been an options trader for a long time. I've been a hedge fund trader. I've traded my own accounts. I've traded other people's accounts. And I've been a registered investment advisor for over 17 years. The one strategy that I find the most useful for me, especially when I'm able to do what I am at Fidelity, is to sell puts. By selling puts, I'm able to collect a premium and essentially be able to possibly buy an ETF or a stock at a much lower price. Now, this video isn't going to be about the basics of selling puts. This is going to show you what I've learned over the years as far as my specific strategy that I go about. And this is pretty much the only trade that I put on most of the time in my accounts when it comes to options. So I am in Fidelity right now, and I'm in the trade ticket. So in the top left portion of your screen, you're going to see a trade option, and you want to come up here once you have that clicked on, and you want to go to option chain. And that's going to pull up the option chain for this particular stock. Or in this case, it's an ETF. I've been trading a lot of IWM, iShares Russell 2000. I think the small caps are severely undervalued right now, and interest rates are starting to go down. And that is when small cap stocks tend to do a lot better, is when interest rates are going down. It also helps that they've been down for a long time. And so what I'm doing is any day that is essentially down, I am going in here and I'm checking a few things. So first of all, let's get rid of some of this clutter on the screen here. I only trade, I'm going to get rid of today's options. I'm going to get rid of all the options on here. And this one's going to be highlighted. This is the only option I want up on the screen. This is going to be tomorrow's expiration. So what I do is I essentially trade one day out. I'm going to be looking at these different put options. So I'm selecting put options, and I'm going to be looking only at October 1st. Today is the 30th. And I'm going to be looking down here on the options chain. And there are a few things I'm going to want to look at. First of all, I'm looking to get into this possibly at a much lower price than what it's currently at. So the first thing that I look at is over here on this far column where it says delta. This is basically it's a chance that you're going to be profitable, okay? It's roughly the chance that you're going to be profitable. So if you go down here and you can see here .1363. So essentially what that tells you is anytime there's a negative, that means that there is going to be 1 minus this amount is the rough probability of profit that you're going to have. So 1 minus 0.1363 is about 86 and some change, 86%. So I like to trade put options that are roughly 85 to 90% win probability. And so this is the only one that falls in that category. This would be too little and this would be too much. So I'm here looking at the 0.1363 delta, and I'm also looking at this number right next door. So implied volatility is important as well. This tells you roughly how much volatility there is in this contract. And in order for me to make a transaction, I'm not even looking at anything that has an implied volatility of less than 20%. It's just not going to move a whole lot. And I want to make sure that I'm going to make some money on this particular option, and it has a little bit of volatility built in. That's essentially the premium that you're getting paid has the volatility built in. So the more volatile, the more premium you should be being paid for this options contract. So I go over here, and it looks to me like you will get paid 20 or 21 cents per contract on this. Okay, so what you're going to do is when you're selling puts, you're essentially saying that I am willing to buy IWM at 217. If it goes below 217, you're still going to pay 217 for it, regardless of where it goes to. So right now it's trading at 220. All right. So I can select this and I can hit sell. And over here, it's going to show me that I'm going to collect roughly $20. You know, it's basically 100 shares times 20 cents or $20. And the estimated max loss is obviously the entire amount of 217 multiplied by 100 shares minus your premium. So 217, let's just go ahead and do it. 217 times 100 shares minus 20. There's your max loss, and that matches up with Fidelity has right here. And then the nice thing about Fidelity is, remember I told you how to calculate that probability of profit. Well, guess what? Fidelity does it for you on the trade ticket here. It says 87% chance of profitability. So what you do is you'd preview this order in the trade ticket, and you would basically execute that transaction. And the next day, you'd come in here, and it will either expire worthless if the stock ETF, in this case, is above 217, or it will basically assign you the shares if it goes below 217, which means it will put 100 shares in your account at $21,700. So in order for you to make this transaction, you have to have cash available in your account of $21,700. Fidelity will allow you to double dip, and this is a part of the reason why I wanted to make this actual video today, and that is they will let you keep your money in cash in their core account, and you will collect a money market rate of return on that cash of roughly 4.6% right now, and you can use that money. So in my case, I have roughly $30,000, so I can make this transaction. I need to have $21,680 available in cash to be able to secure my transaction with the cash that's in my account. I can double dip. I can collect that 4.6% on the money market that the $30,000 is sitting in, and I can execute this trade, collect $20 to take on the risk of the put, and so I will collect the $20. I'll also collect interest on my core account as well, and then if the ETF closes above 217 at the end of business on October 1st, which is tomorrow, then I'll essentially collect this $20. This order will go away. It will expire, worthless, and I can do another one the next day. So I'm collecting income pretty much every day on this put process. Any day that the market is down at least a little bit, the implied volatility, remember the implied volatility right here has to be above 20, and the delta, I like it, is when in the way they put it out here on Fidelity is I like it between negative 0.1 and negative 0.15. That indicates the chances of profitability, and they'll essentially spell it out right here on the order ticket. And that's how I trade, guys. I've been doing this for years. I collect, in some cases, several $1,000s a month between multiple accounts. This is just one of my accounts. I've got several other accounts that I trade as well. And if you do it in a Roth IRA or a retirement account, all of it should be tax-free, on a Roth IRA, and tax-deferred in a regular IRA. So that's even more of a benefit. But I like to be able to double dip at Fidelity. That's the reason why I was showing you how I do it at Fidelity, because they're one of the few brokers that allows you to collect that interest on the actual trade as well as the overall amount that you're collecting from selling the put. So if you guys want me to discuss the basics of puts in a future video, just leave me a comment below. Otherwise, that's all there is for today. I just wanted to give you guys a way that how I pretty much have been trading for a very long time. This has been a very profitable venture for me over the last 10 plus years that I've been trading this style, and I wanted to give you exactly what I do on a regular basis. I appreciate you guys for tuning in. Thank you very much. Hit the like button, subscribe, and I'll come back to you with some more great videos for you in the near future. Thank you all.